Hello everyone, today I will present my fundamentals of private and public finance report. Firstly, the exclusive right in issuing the local currency banknotes in commonly vested with the central bank. Currency in circulation represent those banknotes and coins produced and issued for use in the economy. Currency in circulation does not include notes and coins kept in the vault of the central bank, including notes and coins returned to the central banks by banks. The notes are non-interest bearing obligations that must be paid immediately. Data on the amount of the money in circulation as of the reporting date, including the compare year, should be provided by the central bank. The worth of the coins and banknotes used to represent those amounts in the local currency must also be disclosed. In this case, the policy considers the best practices. Considering the relevance and dependability required in, and this should be declared as required is in. Considering the nature of the central bank operation, IFRS do not particularly apply to this operation. These are my topics. The first topic is what is the currency in circulation? The quantity of cash in the form of paper notes or coins that is physically utilized to transact businesses and consumer transactions inside a nation is referred to as the currency in circulation. The total amount of currency issued by a nation's monetary authority, less money taken out of circulation. A component of the total money supply is represented by currency in use, and a piece of that total money supply is kept in checking and saving accounts. Contracts for assets with a monetary value are referred to as financial instruments. Depending on the assets in question, these contracts may be made with a variety of suppliers such as banks or brokers. Companies employ various financial tools. For instance, when they seek to raise funds, in this station they can issue shares to get capital and money from investors in return. Financial instruments are also used to protect capital, such as when a business needs to guarantee a specific exchange rate for transactions involving foreign currencies. Financial instruments can be divided into three different classes: cash, derivative, and foreign exchange instruments. First of all, cash instruments is currency market conditions have a direct impact on financial instruments in the cash class. Loans and securities are examples of cash instruments. On the stock exchange, securities are exchanged. A stock of the corporation that issues the securities is given to the buyer of the security. Shares are one of the most well-known types of securities. When there is a contract between the lender and the borrower, loans are also cash instruments. These agreements details such as the interest rate and the amount of the monthly interest payment when the loan is repaid. Derivative instruments. In derivative instruments, the value is derived indirectly from the underlying assets of the derivative. There are many different assets, for example, raw materials, currencies, shares, funds, and bonds. The best known derivative assessments are futures and warrants. In the case of futures, a transaction in which derivatives are exchanged for cash at a predetermined future date at a predetermined price is contractually defined. In the event of the warrant, the option seller gives the customer the right to acquire further derivatives at a fixed price within the set time. Foreign exchange instruments. Foreign exchange instruments are transactions that are concluded on the currency market. These include, for example, spot transactions, outright forwards, currency swaps. A spot transaction, often known as an on-the-spot currency exchange, occurs no later than the second business day after the transaction's conclusion. Outright forwards, commonly known as currency forwards, involve the exchange of currency at the predetermined rate and not following the spot date. As a result, investors are shielded from significant exchange rate changes. In swap transactions, funds are concurrently lent in one currency and funds of a different value are lent in another. Two parties exchange the same amount of money with one another in two distinct currencies. The funds are subsequently exchanged back at the predetermined maturity date and exchange date, and the original amounts of the two parties are returned in the respective currencies. Financial instruments examples for some assets. Financial instruments can also be classified according to asset class.